Okay, hello and welcome to episode 2 of the Technical Bootcamp. Today, we are talking about market structure. So in this class, we are going to break down basically the core element behind all technical trading, which in my eyes is market structure. I'm going to show you what it is and how you can plot it on the charts and understand it when you're viewing it in the markets. I'm going to show you different trending phases and how to spot true versus false reversals so you don't get caught out. And we'll talk through pitfalls, mistakes that people make, and how you can avoid them to get the best result. With that said, let's jump over to the charts and get right into the class. My goal with this episode of the bootcamp is not to simply show you how to trade with market structure, although of course that is an important element, but it's to show you why I believe this is the best way to actually trade the market from a objective point of view, where you're following the real price structure that the market is printing for you. Now, I'm going to start by showing you why this is and why I want to put so much emphasis on real market structure. Okay, we're going to do that by just showing one of the arbitrary ways that people try to define the trending direction of a market without understanding the real price structure and how this fails in comparison to what we're actually going to look at today. So the tool in question, the approach in question, is of course going to be a trend line, which is a very simple tool that a lot of people use. The idea with the trend line is, and look, if you already understand this, please just stay put. It's only going to take a couple of minutes to get through this, and you will also understand the emphasis I'm putting on market structure itself. So the idea with this trendline tool is you connect two or more lows, and then if this creates an ascending trend line, like this, a trend line that's moving up, any price action above this line is bullish and you should look to buy. The idea then is you buy retests. So after these first two taps, you would have bought this one, and then you would buy here as well, which obviously this one would have lost. And then the idea is underneath this trend line, if the market breaks beneath and closes under the level, that then creates a bearish market, a situation that you should look to sell into. So in the approach of arbitrary tools like this, above the line is bullish, below the line is bearish. It seems logical, it seems like it makes sense, but there is one big problem with it. And it's that we are trusting a tool or a line that realistically in the real market is imaginary. It only exists because we just drew it on. We are trusting this over the real structural printing of the candlesticks in question. So if we look at structure from this point onwards, from a real high-low structure perspective, which is raw price action, what we are looking to do to determine the direction of a trend is mark out the highs and the lows and see which way overall the real price, which is what is being printed by candles, is actually moving. Now in question here, that would be, here is our low, okay? We have a high just here as well. So this is like our previous high. We have then had a drive from here to here. This creates what we call a higher high because this high is higher than the previous one. We then pull back down to here and we create a higher low because this low is higher than the initial one down here. Then we again drive higher from this point to this point, creating a higher high again. Then we come down and create a higher low again. And then we make the final drive up to create a higher high over here. So if we look at what the market's actually printed, not what our drawn on imaginary line tells us, we can see that the market is clearly trading upwards. And what these candlesticks show is confirmed and rejected real price action. It is the real market price printed second by second throughout the entire day, never ending in a big flow. So what this is telling us, the candles, is significantly more important than what this is telling us, the trend line, because this trend line is just a line that we draw on the chart. It's not actually the high-low structure that's being printed by price. Now, if we see that the real structure of the market is printing highs that are endlessly higher than the previous and lows that are endlessly higher than the previous, well, we have got the most clear information there that this market is indeed moving up. We can see that with our own two eyes. It's very simple, okay? If this market then continues to make higher lows and higher highs, that would be a market of which we would want to buy. If the market was to break into a lower low, so printing a low that's lower than the previous, for example, in this market, it would look like this. If we were to get a closure down here, that would create a lower low, which would change the overall direction of this market. And what we would want to do then is, rather than looking to take this higher, actually expect a lower high, a lower low, a lower high, and so on and so on and so on until that shifted again. So when we're looking at high-low structure using raw price action, we are simply looking which way are the candles going. Are they creating higher highs and higher lows, or lower lows and lower highs? And then we trade with the existing, current, proven direction of the market. And that is what makes these arbitrary tools like trend lines, and the other one is moving averages that people use. That's what makes these essentially obsolete or incorrect, okay? Now, of course, if you win with trend lines or moving averages, I am not telling you to stop. Do what works. You can make pretty much any system win. But when it comes to the actual structural view of a market, it is objectively incorrect to trust trend lines. Because now that we understand the real high-low structure of this market, what can we see? Well, if you were a trader who trusted this trend line, and the standard way to trade a trend line there is if it breaks, you sell the pullback and retest of that level, you'd be looking to go short here, thinking that this market was bearish, when objectively, based on the price action, it is not. It's a bullish market because all we can see is that it's created a higher high and it is now in the process of pulling back, but it hasn't broken through a very notable higher low. So price itself is saying, no, this market is going up, okay? We don't have any reason to believe this market's going down. We are going up. Every high we're printing, every low we're printing is higher than the previous one. So this is actually a bullish market that should be bought into. And if you trust these arbitrary tools, you're going to be caught on the wrong side of this market a lot because you're now looking to sell a bullish market. Now let's see exactly what happens next. In this example, as you can see, we drive higher. Based on the high-low structure, that is completely obvious because all we've done is go and print again a new higher low and then a new higher high over here. So when you look at the raw price action, it's a very simple trade. When you look at arbitrary tools, you're caught on the wrong side of the market where you really don't want to be. So that is why we are going to focus in this class heavily on high and low structure of real price action. The information the candlesticks themselves tell us, because this is the real information of the market, not arbitrary tools, not indicators, not trend lines, real price action. So with that said, we're going to jump in now and talk through trend phases, but hopefully that's given you an understanding as to how important it is to read the market through the true lens of price. Okay, so the markets can really only move in one of three phases. There are only truly three directions that the market moves. An uptrend, where the market consistently prints higher highs and higher lows, just as we previously discussed in that example. A downtrend, where the market is printing lower lows and lower highs, as we discussed again. This is where the market's moving down. And then a consolidation. This one is pretty much just a mess where the market is going sideways. Now, a lot of people will mark out as a consolidation as pretty smooth like this. It's not always like that, okay? A consolidation can be a point where the market's made a higher high, but then it goes and makes a lower low, then it makes a new higher high. And really, it's just a undirectional phase of the market, which is really hard to understand. It's not making clear upward moves. It's not making clear downward moves. It's just chopping back and forth, okay? Now, the classic ways to trade each of these different phases, it's actually very simple, as you can imagine. In uptrends, we want to buy. In downtrends, we want to sell. And in consolidations, we just simply want to do nothing. That's pretty much how we trade the market. Now, these things are so important because, of course, we want to know when we should be buying a market, and trends tell us exactly that. If the market is continually pushing to make new highs and it is continually forming lows higher than the previous, this is a phase of the market where we can incorporate all of the other concepts that you're going to learn in this bootcamp to actually buy. If we're not creating this kind of price action, then there simply is no buying opportunity on the table. This, of course, will filter down trades you take. You're not going to be taking trades against the trend. You're not going to be getting endlessly chopped out of trades. You are only buying when the conditions tell you to buy, based on this high and low structure. Downtrends are the same. If we continue to see the market breaking structure into new lows, and we continue to see the highs being printed lower than the previous highs, then this is a condition of which you would want to sell. And anything other than this is not a selling setting. Therefore, you're only going to be taking trades on the downside in prime conditions to do so, okay? So downtrends for selling, uptrends for buying, consolidations, as we see, if we can't make clear sense of whether the market's going up or down, we simply don't take any positions. Therefore, we're not going to be getting chopped and liquidated back and forth. I'm sure you've probably experienced that at some point. If you just stop trading in these messy ranges, you don't have to worry about that anymore, okay? So these are the three core phases: uptrends for buying, downtrends for selling, consolidation for going and doing absolutely anything else. Don't get in these markets. All right, let's talk through the dynamics of this then, and also what reversals look like in these markets. So we have here a clearly plotted uptrend of higher highs and higher lows. Now you can see I've drawn this little tool on that says BOS. This means break of structure. I use this term when structure breaks into a new high or a new low. I don't use chalk, MSS, all the weird things that people use. It's a break of structure. Structure broke, so that's simply what we call it, okay? So you're going to see these throughout. Here, BOS simply indicates a point where the market has broken into a new high or a new low. Now, these tools are most useful for basically indicating where future breaks or future movements would become relevant. But before we get into talking about how we do this in real time, let me talk about the general way that we want to trade this. So with an uptrend, once we've created higher high, higher low, higher high formation, so basically a move like this in the market where structure is clearly broken, we are then of course seeing an uptrend, and our idea is then going to be to buy that uptrend. So we want to get into the market somewhere from this point down to this point in order to follow this movement up. Now, obviously, we want to buy as low as physically possible because the lower we buy, the better price we get, the bigger the profit will be on the movement up. So if we see this higher low print here, and then we see the higher high print here, our goal is then to buy as low as possible in this range above this higher low. If we buy beneath the higher low, if the market gets down here, then this is actually a bearish market. This is what indicates reversal. And what we would actually have here is a BOS, break of structure, to the downside. We would then anticipate this to be followed by a lower high, so a high that is lower than this one. And then we would want to sell that into a downward move, which would basically indicate the start of a downtrend. All right. So if we break through a higher low, we immediately print a lower low, therefore changing the direction. But if we stay above the higher low, we want to buy as low as physically possible in this point so that we can take the market higher through its next impulse. We overall expect and anticipate this market should be bullish because it is moving in a bullish fashion. So we would buy down here, anticipating an upward move. We would profit heavily if the market does continue through to the upside, and we would only lose a little bit if the market goes down here because we can get out very quickly, understanding that this is basically the invalidation point for this trade. Okay, so that's basically how we want to trade it. We don't buy when a new higher high is printed. We buy once the market has had some relief, some exhaustion, and the market slows down. When we start to see that pullback move, this is our opportunity to get in at a good price, and we can look to take the market higher from there. Okay, so that's basically how it goes in terms of higher high, higher low structure inside these markets. Now, to show you how we do this in real time, then here is an example. We've printed a high, higher low, higher high, higher low, higher high. We are now in a rather bullish market. Everything is looking pretty good. But if we wait for that to happen, we're going to be too late to the trade. We're going to be buying at the high, and the market can easily pull all the way back, meaning our risk reward would be terrible. The profit we can make on this trade would only be small. The downside would be huge. So what we do instead is we basically use this as confirmation, the previous trend direction. Okay. If this is impulsing to the upside, creating these breaks of structure, we just trust that the market should continue in that fashion. We buy in as close as possible to the low, profiting from that large move up. That is generally how we're going to trade it. And that is why we need clear trend direction. Because if we don't understand which way the market is trending, whether a downtrend or an uptrend, then we're not going to understand which side of the market we should be buying or selling into. This essentially gives us the confirmation and the backing behind our trades, so we can make those somewhat difficult decisions in real time when uncertainty is high. Okay. Of course, we're not going to win every trade because sometimes the markets will go against the overall direction and create one of those market reversals. But this is where the really good part of trading market structure comes in. If we were to see the market break down, let's say we bought into the market at this higher low, we have our stop loss down here, our target somewhere up there, and then the market fails on us and actually closes to the downside. Well, yes, we take a loss, but what this actually does is truly prints and truly validates a new setup for us. The real market price structure, the candlesticks, the price action that's being printed, have just told us this is no longer a bullish market, it's a bearish market, and we should be looking to sell. So now that the market has created a lower low, at this point, we can look for opportunity to sell, providing it stays beneath the high. So this is our high. This is now our lower low. So anywhere underneath that high is a valid point for us to sell, okay? If the market was to push back over this high, then that of course would change the direction again, like this. But now that the trend is printed, we generally will expect it to actually just go bearish. Then we'd be looking to sell a lower high towards a new lower low. It's actually rather simple, okay? So if we're printing bullish breaks of structures, higher highs, higher lows, we buy in this market with anticipation of continuation. Eventually, it will fail us and reverse, breaking into a lower low, which just immediately validates opportunity to sell lower highs towards new lower lows. That would be the downtrend. That is basically what the market structure dynamic looks like in real time, and that is how you trade it during uptrends, downtrends, and of course that crossover point, the reversal, between trades, which in the moment when you're losing a trade can feel tricky, but you have to remember every break we get, every failed opportunity you get in a market structure based trade immediately validates a new opportunity for you to take the market the other way and of course win a significant amount on those positions. Now, the trending movements that we look at, these higher high, higher low break of structure moves, can be defined in two different terms. We have impulse moves, impulsive moves, correction moves, corrective moves. It doesn't matter, same thing, okay? So an impulsive move is a drive that creates a break in structure. So if we take a look from this low to this high, we see that the movement that occurred here broke us past this previous high. Therefore, this is an impulsive move. An impulsive move or an impulse move is a pro-trend movement, okay? That confirms the direction of the trend or sets the tone of the market direction because it drives us through a previous high or low. A corrective move is a movement that takes place within the range of an impulsive move without breaking a high or a low. So if we take a look now from this high down to this low, we see that while the market did make some meaningful ground, it didn't break through this low and it didn't break through this high. So therefore, it's a corrective move. You can see a correction as basically a slowdown in the market or a point where buyers are a bit exhausted. Sellers step in for a short time before buyers step back in for the new impulse, okay? So then we do see after that, of course, from this low to this high, we get an impulse move, which is broken through this high again. That's therefore creating the impulse. So corrective moves are counter trend movements that just slowly pull back. Impulsive moves are pro-trend movements that set the direction of the market by creating breaks of structure. So those are the two types of move. Now let's look at a little bit of a trickier piece of price action. This is exactly what we just broke down in that previous example. And I know this probably did catch some people out and confuse people, because you might be seeing, well, we've had breaks here, right? Isn't this a break of structure at this point? Well, no, because this is what we classify as internal structure, everything that happens between this high and this low, okay? So to break that down in simple terms, we're gonna follow the same impulse correction format. If we have our impulsive move here, that means that any movement that happens from here downwards that doesn't break this low is a corrective move. So we would basically initially just see this movement as a correction, okay? And then this little pullback doesn't mean anything because again, it's not broken an impulsive move. It's not a pro trend move. It's just a random bit of pullback in the market. Then we have the next movement down here, which actually changes the picture a bit because we do go and break through the low. So what we've done here is break through our previous higher low and create a new lower low. So that therefore would mean that this entire movement, so we can simplify this to one single move, is an impulsive move, right? Because we went from this high and we impulsed all the way down to here, breaking through this low. So this entire movement, even with the little bit of chop and pullback it had in the middle, is actually now just one impulsive move because it's the next pro-trend movement from this high down to this low. So that is going to be an impulse move. That then means this move from here up to here, it didn't break through the high and it didn't break through the low. So therefore, this is a corrective move. All right, that's going to be counter trend movement that doesn't create any meaningful breaks. Again, as we've said, a little bit of relief for the buyers. We get that short correction and then the market drives into another impulsive down, creating a new lower low. Okay, so an impulse is a pro-trend move that creates a break of structure by pushing past a high or a low. A correction is a counter-trend move that creates no meaningful breaks and trades within the boundaries of an impulse. They're going to be messy sometimes like this one, that's why I'm showing you. It's not always going to be super smooth. Sometimes they will have these pullbacks and chop within them, but essentially we want to view this as waves, as larger picture, broader movements following that high-low structure. If we didn't break through any high or low, then it doesn't matter how much sideways action we get there. It's all going to be one impulse or one correction once the high or low has been validated, whichever way the market decides to go. Okay, so that is the theory of impulse and correct. So now let us return to that bit of price action that we marked at the start of the class. And we're going to now mark this up with the impulses and corrections, just so you can see how we determine this view in a real market. All right, so we have obviously our low printed in here. This is the lowest point in the trend. If we then look, basically we're not really worried about any of this consolidation because our previous high was really this point. So we've driven down like here. This was one impulsive move, okay? So that is a bearish impulse. Now from that, we see the high just here, broken just there. So this then becomes an impulsive move up. So we have an impulsive move down, which comes out of the back of this downtrend. Then we have this impulsive move up. That's why we're not worried really about the price action that's taken place here, because it's underneath the notable lower high. So we don't worry too much about any sideways chop, because until it breaks through a notable high or low, again, it's not really a valid or worrying move for us to even think about. So essentially, when you're looking at this impulsive and corrective price action, it can actually look like this a bit, right? You can get these ups and downs inside of these moves, and your job is simply to find those relevant highs and lows and mark them out. So again, let me just reiterate this. This is an important point we'll come to soon. Why is this not marked as a low and a high? Well, that's because the closure we have here is actually just wicks. It's rejection. We want to see candle body closures to actually validate highs and lows for viable trends, okay? Being a wick with rejections is not something we need to worry about too much. Okay, so the next movement then is the small corrective pullback move from here to here. This is a correction. So we mark that one as a correct. We then have a impulsive move from this low to this high. That's going to be our next impulse. This is an impulsive move because it created a break of structure. So this BOS sets in motion the new high, right? We've created a new high. We impulsed through a previous structural point, therefore continuing the overall direction of this market. That would then print this as our higher low, and then we would be looking for buying opportunities above this low. And if the market breaks under this low, that's where the reversal comes in. We can see, of course, we didn't get a break of that low. We just got a corrective move from the high there into the low there. So it's a simple correction. Then the high there was broken, creating a BOS break of structure, which therefore creates an impulsive move from this low to this high. What has this done at the same time? Well, this has printed us a new higher low just here. So any movement that takes place above this low is just a corrective move. So this is the point where trendline traders would have been tricked into thinking the market structure had shifted just there with these closures, when price action traders who view the market based purely on direct price can see that this is actually just a corrective move, which therefore remains a buying opportunity. And the expectation will be that because the market is still bullish, it should continue to trade higher and create a new break of structure, okay? Like this, which is our next impulsive move. So that is how you mark these impulses and corrections in real time. Don't worry about the small chop, focus on the larger broad moves in the form of kind of waves is one way I see it. You know, you want to view structure in this broader perspective, high to low focus, not the little chop. Don't worry about that. We want to see the overall flow, what's going down, and that will determine our decision making. That then leaves us with this high to low piece of structure. So what we would do at this point for a real-time trading opportunity is mark this low, and we would mark this high, because this is our impulsive move. Okay. As we know, corrective moves are going to take place inside of the range of an impulsive move without breaking a notable high or low. So anywhere above the low that we've just marked on, which is going to be this low just here, anywhere above there, regardless of what the price does, if it wants to do this for a year, it doesn't matter, is just a corrective move. It is not a notable impulse. Doesn't matter if we come down and we start breaking structure like this. Nothing has actually happened in the broad picture of structure, because if we stay above this low, we will then anticipate continued upward price action. And if we do break beneath the low, so if we do get a push down here, then this would create a bearish impulse, which therefore would set us in motion to a selling trend, downtrend. So let's see what this does. Well, we've actually gone and pushed up here, created a high slightly. We then see the market come down and make a closure on the downside. So one thing we could be interested in seeing potentially now, although we do have obviously imbalances, this is something we'll get into soon, it would be the first sign of potentially getting into reverse, okay? There's a lot more context to it to determine whether a trend is fully ready to buy or sell, but we're going to be getting to that in later episodes of the bootcamp. But it's the first indication we have that there could potentially be some downside if we started to shift. All right. Now, due to imbalances, supply and demand, things we'll get to soon in the bootcamp, this would not have been the case, and it wouldn't have been a trade I would have looked to sell from, but it's just the first indication. And as we get to those classes, you'll start to see how this all comes together. Now, at this point, because we are still under this high, we haven't really validated upward or downward price action just yet. We want to see a notable closure up here, which in this case would then validate our new higher low, which would be down at this point, and set us in motion for continued upward trending move. If we don't do that and we instead come down, well, then that should validate continuation of new downward moves, which, as you can see, is actually what took place here. We didn't really close with strength above here. We just have these wick rejections. The market then came down, pushed under this previous low, creating a lower low. We then pull back, create a lower high, and then we pull down, break of structure there, pulling us into a new lower low. So, of course, real-time markets are going to be a little bit trickier. You'll get smooth price action like this. You'll get the uglier price action like this. Well, you'll have to bring in other concepts to determine directional biases, and then you'll move back into smooth price action again like this. So again, as we've said, if you can't make sense of a phase, if the market is making new highs, then new lows, kind of like this phase here, you can classify that as consolidation and simply not get involved until the market's moving in a new clean trend direction. All right, so there you go. That's the impulses through an uptrend, a messier consolidation phase, but even though not direct, not valuable. A messier consolidation or directionless phase, which even though it's not pretty, 100% worth covering in this video so you can understand what to expect in markets. And then a downtrending phase, pretty clean here with the lower low and lower high structure. That is how we mark these impulses and corrections, and this is what structure would look like in real time. Okay, so from what we've discussed so far, we've basically defined that impulsive moves are pro-trend movements that break through structural highs and lows. Corrective moves are pullback moves that don't break through any structural highs or lows and exist within the confines of an impulsive range. Okay, so the impulsive range would be this low to this high. Anything that takes place here is simply corrective until we make a high or low break. Now, I'm using this then to tell you about a internal structure mistake that you've probably made or are making right now. A lot of people mess this up, and this is one of the biggest points where people go wrong when they're trading real price structure. I know a lot of people that trade structure as I do, and they say it's so difficult and it's so confusing. In reality, it's not, but there are many places you can kind of trip up and get lost that make it seem very difficult. One of those is what I've just drawn on the chart here, which is the trap internal structure. So as I've said, within a corrective move, we can have any amount of chop like this without actually changing the overall direction of the trend, providing we stay above the higher low. But what people make the mistake of doing is they see a movement like this, where the market comes down in a corrective move, prints a low, prints a lower high, what looks like it, and then a lower low. So it's kind of a smaller trend here inside of the larger trend. Now this is what we call internal structure because it's happening beneath the high of the impulsive move and above the low of the impulsive move. But people who don't understand this will see this break of structure here and say, okay, this trend is no longer bullish, it's instead bearish, and we should be looking to sell this market. So then people will go ahead and place orders to sell the market from, let's say, a supply zone or any area of interest up here. They'll have stops above the high, and they're looking to take this market lower because they think this break of structure here is indicating a change in the trend. In reality, it is doing no such thing because the market can easily trade higher, simply then printing this as a corrective move and then the next upward move as the new impulsive move, right? So this is where people go so wrong with structure, by trusting corrective movements and internal structure movements as true price structure. Realistically, it doesn't give us any further information as to breaks in the trend. It is simply a corrective pullback before a continuation of the overall impulsive direction. So that is an internal structure mistake that people mess up with a lot. Let's go look at this on a real chart so you can see pretty much exactly where you've probably gone wrong in the past or are going wrong now with this mistake. Okay, so here we have a uptrend which has shifted into a downtrend. We have an impulse, then we have another impulse which shifts us down here. This begins the downtrend with these closures under this previous low. Then we have our corrective move, which is basically all the way from here through to here. At this point, then we have our next impulsive move, which is where we create a new lower low down to here. So if we look at this trend structure for what it truly is, it's simply a impulse, correction, impulse, okay? Despite all of the little mess and chop that we've got three clear structural points. We've got our low, our high, and our low. Now this is where people get caught up. They will then see the market making these internal breaks, so like this break of structure here, and they will treat this break here, this break of structure we've got there, as a piece of information that tells us this has now shifted back to buys. But if we remember what we've been saying for this entire class, if the impulsive move high, which is going to be the lower high, stays intact, anything that happens under this is simply part of a corrective move. For this to actually show reversals, we would need to see the market closing up here. Then we could happily take buy opportunities like this because we would be beginning a new uptrend. We'd be seeing that point where the market is shifting, okay? So it would be impulse, correction, impulse, but then impulse, correction, impulse. That's the way that we would want to view that. Now what we've got right now on the flip side of that is simply impulse, correction, impulse, correction. So although this in itself looks like a point where the market has shifted structural direction, this should not be opportunity for us to look for significant buys because the lower high of the impulsive movement down is still intact. This is where people go so wrong. So now if we play this forward, what you're going to see actually happens instead is the market just chops around a bit in here, and it's around here the point people would be buying in, trying to take this market significantly higher, and then eventually it just fails and goes down into a new low. That's because the overall bearish structure of this movement is still completely intact. We've got a break of structure here, we've got a break of structure here, and to mark those impulses and corrections on just up to the current point, we basically have then initial impulse, which is going to be the movement down from there to there, so that's impulse number 1. Then we have impulse number 2 from here to to here, and then we have impulse number 3 from this high down to this low, and everything that took place between these points. So this one, that's a correction, and this one here, that's a correction. And when you've got it mapped like this, it becomes very obvious. Impulse, correction, impulse, correction, impulse. But in the moment, if you're not factoring this bigger picture structure of impulses, corrections, highs, and lows, you can get caught up very easily in this kind of substructure price action, which actually isn't showing you any notable reversals, okay? Now, there is a way for us to utilize what we call substructure, which is how we can trade this internal structure safely without making that mistake, and we will get to that soon. But for now, just understand pretty much the picture we've just showed. That is how this market works. And if you're getting caught up trading against the market, expecting big reversals from small pieces of price action that exist within the impulsive moves of the larger trend, then yeah, you're going to get killed by the market continuously. Now, one thing we must discuss is how we determine viable, valid break structure. So for this example, I just want you to focus in on the price action we've got here, okay? What we've got basically is a bearish impulse, bullish correction, bearish impulse, bullish impulse, bearish correction. And then this is where we're really gonna focus our attention for this example. So we have our valid break of structure down here because the market went and closed and made a new low. Then we have a valid break of structure up here because the market actually came up and closed as a new high. So this validates a bullish impulsive move. This is where we would be looking to start buying the market on pullbacks. So for example, you could look at a buy from down here. Now, what we've actually had is, this is where people go wrong. A break that looks like a continuation of upward trending price action, but actually didn't yet create a valid break. And that is simply because we only have a wick closing over the high. We don't have a candle body. Now, if you think back to episode 1, price action, we discussed how wicks show rejected price action, candle bodies show confirmed price action. So if the only piece of structure that is broken through a previous high is a wick, then that is not confirming continuation. This actually shows rejection of those higher prices. So what we would not want to do, whereas this movement is a valid impulse, we would not want to treat this move also as a valid impulse. This means we would not set this as our valid higher low just yet because we don't have a valid higher high. So this is not yet confirmed. Now, if we got a candle body that went and closed over the previous high, so somewhere in this range above this level, then that would turn this into an impulsive move that we could then happily buy from a corrective move when it comes through, okay? But because we haven't had that closure, we don't want to start buying if the market pulls back. So we don't want to buy here with stop losses here because we haven't yet seen this validate a closure, which means it's not yet a valid higher low, which means it's not yet a valid higher high or higher low. So with only this wick closure above, we don't worry about this point just yet, and we actually keep our higher low focused in where it previously was, or our low should be. So we've got our low, our high, and then all of this is actually just chop for now because we don't have that candle body closure. Now I'm going to show you what can happen. Let's take a look if you trust wick. So let's say you bought into the market because you saw this wick close and you thought, okay, this is a confirmed higher high. Well, the market actually trades lower and ends up going underneath what you could have seen as your higher low. So you would have been stopped out down here if you were trusting this low and trusting this break and you had your stop loss under that level. You'd have been stopped out before the market actually made the move. Now, why does this happen? Well, this is something we call liquidity sweeps. We're going to get into liquidity in depth in a future class, but to explain it now, because it does have relevance at this point, if we get a wick that shows rejected price action, closing us over a structural high or closing us under a structural low, such as this one here, which at the moment is just internal, this is a point where actually we are seeing massive buying pressure kicking in at this level and driving higher, and massive selling pressure kicking in at this level and driving lower. Remember, we're always trying to read the battle between buyers and sellers. Closures show clear control from buyers breaking through a previous high. Wicks show a clear reversal in control from buying to selling, failing to close above a high, which means we can come all the way back down through what we could see as basically a false low. That's why we should just stay focused on the initial low that we had printed. So this is our impulsive move, and everything that's taken place here is still just correct because we haven't made a closure above the high or below the low, okay? So we can simply draw this out further. This is still our range, impulsive move, everything here is corrective. We need to see a candle body closure over here or a candle body closure down here to validate this as an impulsive bearish move, or to invalidate this as an impulsive bullish move, okay? So now let's see what happens next. There we go, we get a closure, and this closure pushes us above what we have as our valid higher low, and this closure pushes us above what we have marked as our valid higher high, therefore creating a new higher high. So at this point, we can indeed move this to be our valid higher low. So to break this structure down from impulse correction, we have the low to the high, that's impulse number 1. Then we have this entire phase is simply corrective because there was no closures above or below the impulsive range. And then we have this drive up, which is our impulsive move. That sets this area here as our higher low. And now anything that takes place basically below this high, above this low, is again a corrective. All right, so let's actually just continue it a little bit more, see what happens. We've gone and closed above this high, and again, here's another example. This closure just here with this wick, I wouldn't really like this too much because this is showing rejections over that high. But when we came in and created this bullish candle, this does set in motion a validated high. So now we've got our next corrective move, which is the drive down here. And then we've got the next impulsive move, which is from this high or this low to this high, which sets in motion this as our valid higher low. So impulse, correction, impulse, correction, impulse. And we do not worry about wicks because they do not validate highs. They do not validate lows. They are rejections, not confirmation. Okay, so to recap everything we've discussed so far, which is going to be the foundational layers of market structure, we're going to take a look at this flowing example. To begin with, we have an impulsive movement to the upside. Then we have a higher low printed here on a corrective move. We have another impulsive move to the upside. This phase of price action with the impulse, correction, impulse, breaking structure into highs validates that we are in a upward trending move. And remember, don't get caught in that internal structure trap of trying to sell the market here, because that of course is not a valid point to do that. It's just a corrective move. This sets us into an uptrend, which therefore means we are going to look to buy the higher lows that form for new corrective moves. The new corrective move just here continues the impulsive upward trending price action. And that is the simplest way to trade continuation, simply buying higher lows when the market is continuing to form higher highs and higher lows, okay? Of course, as to how we do that will be discussed in the bootcamp in a future class. Our next class will start getting into that. But so far, we've basically got impulsive movements up, corrective movements down. That's an up. Now, I've deliberately made this messy so you understand what to encounter in real markets. Sometimes you will get that lower low. This is going to trick you into selling. So providing this was a candle closure, we would actually consider this an impulsive downward move. But obviously, we then see an impulsive upward move forming a new higher high. So at this point, basically you would have been stopped out of a trade here, most likely if you'd taken it, or if you'd waited for confirmation, maybe avoided it. But this then sets us into a stage where, okay, this market is not really making much sense right now. We would ideally want to see this really make some clear directional moves before we get into any trades, all right? So this is that kind of consolidation phase where you can't really make sense of that market due to the fact that it's not really giving you clear direct. So that's going to be taking place around there. This movement, of course, is going to be your clear uptrend. So this will be the buying taking place here. So you buy through the clear uptrend, you stay out during this consolidation or misdirection. And then when we start to step into this clear bearish impulse in price action, you can step back in to trade through a downtrend, okay? And as we've said, although we have some chop in here, all of this movement from this high to this low just achieved one thing, which was an impulsive bearish move into a lower low. So that would be one impulse. Then we have continued impulses down, breaking structure to the downside. And of course, those movements in between are going to be the corrective movements back. So we have impulses down, corrections up through the downtrend. We have impulses up, corrections down during the uptrend. And then we have kind of impulses everywhere during the consolidation phase, which is where we just stay out the market. And that is pretty much the basics of market structure, everything we've covered so far. Market structure will be elaborated upon, but this is what you need to understand for now before we move into all of the other important trading concepts. We will get into substructure, trends inside of trends, and more advanced concepts for understanding how to pair market structure with other concepts later in the bootcamp. But for now, I've given you the foundational layer that you need to understand so you can see why raw price action and raw price structure is the best way to view the market directions, and so you can see how to utilize that to actually take continual good opportunities. So with that said, that's the end of this class. Thank you for watching, and I'll see you in the next one.